morning, everyone. Hi. Thank you. Well, good morning. Welcome to DealBook, and not just DealBook, but the DealBook stage. This is beautiful. It's a great way to start the morning. Thank you for being with us. My name is Joy Robbins. I'm the Global Chief Business Officer here at the New York Times. And if you are familiar with Andrew Ross Sorkin and the DealBook franchise, you know how much time, care, and effort Andrew puts into identifying people across the world who are making the biggest change and having the most influence across business, policy, and culture, and the enormous amount of research that he puts into his newsletters and to everything that you'll see on stage today. But what you might not know is everything that you will see throughout the day is completely unscripted. None of the interviewees are prepped, and it makes for incredible, candid conversations. It also often leads to global newsmaking moments, which I'm sure we're all familiar with. But it also is just a beautiful reflection of the power of live journalism. And I say this because I also want to take a moment to recognize the curation of our audience today. You're all leaders in your respective fields, and I think the power of the connections and conversation in this room cannot be understated. And I think one thing we all can identify as leaders is the importance and the responsibility we all feel for long-term value creation, and the enormous responsibility that comes with really identifying the technologies and the influences that are going to really be part of that long-term value creation. And I think one technology we can all agree that is really pervasive and that we're all really contending with right now is the power of AI and the potential of AI. And today we'll hear from Vanguard, one of the world's leading investment firms and most respected investment companies with a legacy of thought leadership on how AI will shape the global economy and the financial markets. AI offers new ways to unlock productivity, but also economic growth. And Vanguard's deep research, which we'll hear more about in a moment, underscores this sentiment. I'm honored to introduce the esteemed panel this morning, but before we get started, please join me in thanking Vanguard for making this morning possible. I'll also mention, just as a housekeeping note, this morning's conversation is being live taped, so if you wouldn't mind silencing your phones, we'd really appreciate it. And with that, please let me introduce Azeem Azhar, founder of Exponential View. Please enjoy the day.
Thank you, Joy. Let's bring on the panelists as well. We've got Arvind Krishna and Joe Davis. Well, good morning, everyone, and thank you for joining this session on artificial intelligence and our economic future. I'm Azeem Azhar. I'm an early-stage investor in AI companies and the founder behind the Exponential View newsletter and podcast, which has looked at AI for the past decade or so. And I'm really delighted to have on this panel Joe Davis, who's the chief economist and head of the investment strategy group at Vanguard, and Arvind Krishna, the chairman and chief executive officer of IBM. We are 2 years on from ChatGPT, and my world certainly feels very different. I have AI products that I use every day in helping me with my research and with my writing, and the markets have also responded. ChatGPT has gifted trillions of dollars in market cap to the big tech companies in the past couple of years. It's created this seemingly unending demand for computer chips and now electricity. I read that enterprise spending on the technologies that underpin ChatGPT, foundation models, should reach $13 billion this year, a market that was almost certainly in the low single millions just 2 or 3 years ago. In my world, where I look at young startup companies building products using AI of this type, we're seeing that the AI-based startups grow faster than traditional SaaS businesses, and substantially so. They reach that $30 million revenue milestone 5 times faster than some of the fast-growing software as a service companies that are now household names. And at the same time, when we look at our day-to-day work, what do people do in offices, in roles in product management, in finance, in sales, in marketing, we're starting to get quite robust academic research that suggests this new wave of AI can improve productivity, that it can be skill equalizing, that is, make the lower performers in an organization perform as well as the good performers. For great news for the organization, maybe a little bit disorienting for people who are used to being at the top. And also scientists now starting to see that these tools can be applied to improve drug discovery or materials discovery. With all of those different uses, I think it suggests to me as someone who trained in economics that we might have a general purpose technology. General purpose technology are a particular type of technologies. They continuously improve. They can be applied right across our organizations, right across our economies. They spawn complementary businesses. They're so powerful. They reshape our economies. But they only come along a few times every century. The steam engine, electricity, the computer. But the ramifications are absolutely enormous. When you get a general purpose technology, think of electricity, it enables lots of other industries, the modern automotive industry, which is dependent on assembly lines, of course, the entertainment industry, pretty much every part of our modern world. And they can also strand businesses, leaving successful businesses with business models that are not viable. Consider what the internet did to Blockbuster. So if AI is a general purpose technology, it's going to have significant ramifications, and I hope Joe is going to attend to that question. Now, of course, ChatGPT and foundation models are not the first AI systems. We've been shipping AI for decades. Arvind's business, of course, has been at the forefront of all of that. But the world does feel a little bit different after ChatGPT. So if we have this mega trend, Joe, I'd love to come to you first. How does your research illuminate whether it's real and how it might play out?
Well, I think the more important question is we're trying to quantify the evolution of technology. And as you mentioned, Azeem, we think of it, there's three forms of technology in terms of it impacts both our work and our daily life. So there's innovation, and there's two components of that. Think of the personal computer and IBM. It augments the work that we do. It also can automate certain tasks. Then there's that additional component, which is what I would call transformation. That changes how we live, and there's knock-on effects. Some technologies do one, but they don't do significantly the other, and only technologies that do all three rise to the level of general purpose technology, and you mentioned them. What I'm very proud of is we spent over 2 years quantifying, going back over 150 years, capturing the evolution of technology, and we believe we can actually predict it out of sample, like several years out. And so we see dynamics in terms of the workforce and job descriptions in labor, and we see it in terms of capital the investment companies make. And if you're in VC, you know the phrase J-curve, which is you're investing in these labor and capital, yet the return on investment's low at the time. And I think the only reason why business leaders do that is because they see a future economic payoff. We've operationalized those academic sort of theories, and because of that, we're able to bring to bear where we think technology will do. And so our conclusion is fairly eye-opening, and that is the consensus view in the markets and from many central banks of economic growth is almost has a very low probability of happening. And so the more likely outcome is we will see a productivity lift along all three of those dimensions. And again, this is not my personal opinion. This is being a data-driven framework because it calibrates to electricity, it calibrates to the personal computer. And then the question is what knock-on effects AI will have, because that's really the uncertainty comes from. The first two around automation and augmentation are fairly significant. And if you think about the adoption, in our analytics, it says we're in the year 1992. If you have 1999 as your frame of reference from a computer and internet perspective.
Arvind, from the perspective of IBM, do you see this as a distinct megatrend? Is this different to the many, many technology innovations we've seen in digital over the past 20 years?
Yeah, so I'll go back to the thought that both Joe and Azeem, you expressed. I think if you step back, artificial intelligence is going to be one of the, I'll say, the eighth technology, and that is going back over 300 years, that is fundamentally transformed. You mentioned the steam engine, electricity, actually automotive and oil, petroleum, are some of the others that came along with that. What happens is you first do get the productivity, and I'll quantify the productivity. We see that almost any enterprise can become 10% more productive without taking, I'll call it, substantial risk. Take, for example, healthcare. Yes, AI being applied to oncology, diagnosis will happen. That may take a decade to play out. That's not going to be simple or easy, because the moment there's a life or death decision in the play, you should get regulators, you should get guardrails, you should be a lot safer. How much administrative burden is there in those industries? So is it going to be easier to file claims? Of course. Is it easier going to be to procure supplies? Of course. Are you going to be able to make your supply chain, your inventory, all those things that you don't see but are the underbelly of any modern industry, including healthcare, are going to play out. I'll take an example from ourselves. We spend about 15%, I would call it, on all these things, operations, back office, those functions. I will easily see 30% of it come out completely over 5 years. Not in 1 year, but in 5 years. By the way, half of that we already have out. So that tells you that the rate of adoption 2 years in out of the 5 I'm claiming is going to be there. So then you begin to say, if you want 10% productivity, ask economists, not engineers like me and my company, and 10% productivity is massive. It's not actually a simple thing to go get. Then you're going to get, as you go along, like, who would have predicted Netflix in 1995? By 2000, you were beginning to predict it. So are we going to get new industries coming up? Because the cost of doing something is going to go back to 1% of what it might have been. So when you originally imagine some industry, you look at it and you say, okay, this is not feasible. There's no way to make money. When the cost of doing it drops to 1%, suddenly it opens up possibilities of doing things that you couldn't do before. That is going to be always hard to predict exactly what those are, because that lies at the intersection of hidden demand and also creativity from people. And that is, of course, down the road. But the 10% is here and now. And I would urge people to embrace it, to go get that, because then those who have it are going to be advantaged, right? So it's always the same three. Productivity, I think, is a given. You're going to get growth for those companies, because productivity means you have more capital and more dollars to go reinvest in getting more market share. And then 3, it will transform economies. A point that got hidden in all this, how much of the current US economy, the fact that it has the highest growth, the fact that it has more companies of high market cap, about half, I think, of the world's total lies in the United States, is because of the fact that the United States embraced the internet first, and hence, as a consequence, other than China, almost all internet companies are based out of the United States. There is a correlation then to getting a nexus of that capital and that growth in this place. And AI, I think, is going to be at that same scale.
That's wonderful. I want to pick up a follow-up question for you. You gave a great example of IBM's own internal improvements, and I think you said 30% to 15%, yes. And so you're 5%, easily within reach. Can we look at the other side of your business, which is serving big enterprises? Mm-hmm. So help us understand how quickly in the last 2 or 3 years this AI practice built on this new suite of generative AI tools has grown, and how does that compare to previous waves?
So we got to over a $2 billion. Our formal number is we have a $3 billion book of business, meaning how much business have we signed up that clients have asked us to deliver for them. That is 15 months into this journey. We were at $0 in May of 2023. So that's the starting point. We start measuring from then, and we are at over $3 billion now. Of that 3, little over 2 lies in the services business, meaning clients come to us for expertise to help them deploy artificial intelligence. And we are trying to be quite narrow in our perspective here. We don't want to scrape up if you're doing a big SAP projects, of which we do many. We're not counting that as a generative AI project. So these are projects that are narrowly around generative AI as defined. That tells you the rate and pace, to the point of when I look at the original practices around CRM or ERP, those took 10 years to get to that size. This has taken 15 months. I think that kind of says it all.
Joe, forgive me, I want to ask Arvind one more thing, just push down here a little bit further. So of that $3 billion, how much of it is execs reading about Gen AI, feeling they need to have a proof of concept, trusting IBM, coming to you, spending $10 million, and how much of it is really investment by companies where somebody at the C-suite is putting their reputation on the line, say we want this to work?
I would actually tell you it's somewhere in the middle. Are people going and doing $100 million projects to say this is going to make a fundamental difference to the company? Not yet. I wish we got paid for proof of concepts. We don't get paid for proof of concepts. In most cases, we have actually set up a team in the thousands who will go and help our clients kick the tires on our technology and others, because that establishes trust and gives them a sense of what to go do. Most of our projects would lie in that 1 to 15 million range, where people say, I want to do something. This is much more than a proof of concept, because they'll come to us when they really want to get something ready for production, but they're not yet ready to say, I'm going to scale it across the entire enterprise. So somebody might come to us and say, let's imagine replacing portions of our call center with generative AI-driven answers to people. They'll begin with one little domain. That may be 5 million. They get comfortable around it. They begin to see that over half the cost can be taken out, but at higher consumer satisfaction. Because remember, AI agents don't get angry, don't get snippy back to their customers, actually get better and better over time, not worse. And if people get happier, then they'll say, let's scale this across. And I think we are right at that point of them saying, let's scale it across.
Right, thank you. So, Joe, let's look at the other side of this, which is the nature of the people doing the work today and how they relate to these AI tools. You've done a lot of work deconstructing what a job actually is. So what does that tell us?
So what we've done is looked at every job description in the United States and the world, and think of your own job description. There's probably 27 or 28 line items in that job description. That's what economists would call a task. That's what Arvind was referring to. And we've looked at AI's current abilities, and you looked at also the future evolution, and there's uncertainty how much it will further advance, which is why you get some estimates. By the way, we've done this with a personal computer, which would have told you in 1985, we had one of the largest changes in the workforce up to that time in the preceding 40 years. We're seeing a similar sort of activity. What we are finding, however, is despite some fears, AI will unlikely be dystopian, meaning massive job losses, because the number of tasks that are needed to fully automate a job, roughly one in 5 job occupations in the United States, however, will see significant displacement. That's good news for economists, because economists will say, oh, that's high productivity, but there is some, but it's only 1 in 5. What's more important is over 60% of occupations, including, I would presume, everyone in this room, will be augmented more by some automation and then some power tools. Think of the personal computer and how you're able to get better insights. That is of the order of 65%, and it's everything in medicine, education, finance, IT. And there's roughly 20% of occupations that are not have meaningful impact. So when you add that all up, what that is telling us respectfully is that there's greater than a 70% probability that every economic forecast out of central banks is incorrect. Because productivity is going to rise to a level, and I'm not just saying this is a personal view, this is a quantitative estimate of what it will do. And the funny thing is that actually in the United States, we need automation. The biggest reason why growth has on average been low since the global financial crisis is not debt and not demographics. It is the biggest drag is the lack of automation in a service-based economy, the biggest drag in over 100 years. And so if AI is transformational, which means it has to continue to advance roughly threefold. So if that happens, just to give me the power of quantifying this, it will be as if the dividend from automation will be as if the baby boom generation never retired from the workforce. That's a pretty powerful lift. So it will be disruptive in our work. We will likely see the greatest change in job descriptions if we're the year 2035, if our central projections are correct.
Right. So let's just double click on that a little
Yeah.
bit. The change in job descriptions. There's a famous paper by David Autor,
Yes,
The
very good.
Economist,
Yes.
which looks at the nature of employment in the US today and sees that 60% of people are in jobs that didn't exist
Yes.
at the turn after World War II. How do you quantify that going out, say, just you said to 2035 in 11 years? What's that like for like measure? What percentage of people will be in jobs that currently don't exist?
Well, what we don't know in our system is what the new industries will be. If someone can help us with that, I think that's an earlier retirement for this humble economist. But what it can tell us is that there is a blip on the radar screen that it will happen with odds and probabilities. So then it's going to be, what areas could it be to unlock what to call, Arvind, you mentioned the knock-on effects, right? You mentioned electricity. We don't have the entertainment industry without electricity, air conditioning, lights. Actually, think of this theater. We don't have the entertainment industry without electricity running through it. So there's 3 areas of the economy that we think would need to happen for AI to be truly transformative since the personal computer. And those areas would include areas that are of high cost, that have been tough to automate in the past, and are a fundamental or unmet human need. And 3 areas that jump in our scorecard would be clean and inexpensive energy. Second would be more preventative medicine and healthcare. And the third one would be along the dimension of education. So again, I don't know what that will be, Azeem, but you think about if AI is going to be transformed, starting to think about those new effects. It's not just about saving time. What is the unlock? Well, we're just identifying statistically, and we do it out of sample with electricity and personal computer. There was unlocks. I just don't know what that blip on the radar screen actually manifests itself in a new company, new business model. But we're projecting that roughly 5 years out, given the back tests we've done against every other technology since the Industrial Revolution.
Azeem, could I build on Joe's point?
Yeah.
So let's take an example that is real, but is historical. In 1900, 47% of the US population worked directly on a farm. By 1950, that was 3%. What enabled it? It was automation because of machinery. Which industries came about? Because now people had time. If you're working on a farm, it's 7 days a week. It's not 5 days or 3 days or 2 days. It's not hybrid. So that enabled malls. It enabled fast food. It enabled restaurants. It gave rise to what people used to make fun of in the 19th century as the leisure age. It enabled all that. Now, of course, you also needed the automobile because that's how you got to all these other places. But literally 20% of the economy around the whole food, entertainment, and shopping industry came about because you freed people up from having to be at the farm. That is what Joe is talking about is really hard to predict. But every one of those 44% was not unemployed. Other occupations came up because of what was possible.
Yeah. But of course, going from 47% farm workers to 4%, we also went through, I believe, 2 world wars and a huge recession, depression, in fact. And so I suppose one question that we might ask ourselves is, given that we now have some good forecasting tools, Joe, your team's work, and we have the benefit of this historical hindsight, are there appropriate approaches to prepare for this high likelihood you've described of 20% of the jobs being displaced, 60% of jobs substantially changing, and 20% of jobs having to actually being largely unscathed? So what are the possible proactive steps that we could take, perhaps at a policy level or even at a corporate level?
I think from my thoughts, again, from economists, I'm more interested to hear what a CEO of 1,000, but I think from what I would be thinking about as a business leader, again, as an economist, would be one is I would not just be looking in IT, but I would be thinking about from my HR department in that integration. So you have to make a little bit of a forecast. What should the job description be 5 years from now, and then reverse engineer it back and start experimenting all along the way. I'm not saying companies aren't doing this, but to push it at scale and to reward, I would respectfully say, reward individuals or workers for trying to automate significant parts of their time, as well as, secondly, looking at adjacent fields. So if I'm an investor, it's not just looking in technology, but who is utilizing it. It's funny, we find that roughly half of the historical value premium, which is over the long run, value stocks outperform growth stocks. What we've just found is half of that value premium emerges when general purpose technology broadens out to the broader economic ecosystem, because companies outside of tech, call it a hospital, call it a mining company, they are utilizing for productivity and unlock. So I think those would be the two areas, is looking at adjacencies from an investment standpoint or from a corporate strategy standpoint, and what Arvind mentioned before too, but looking within one's organization. Now it takes a little bit of a forecast. What is the job description 5 years out? And then start moving towards that, because that is where the puck is going.
So it sounds like there are a couple of threads I want to bring together. So Arvind, you talked about what happens when something is 1% of the cost that it is today, and how challenging it is for executives to think that through. Joe, you talked about how difficult it is for us to understand what the new industries are and what the new jobs could be. So it seems like what's almost required at an executive level is a degree of imagination and a degree of experimentation, which perhaps execs have not been rewarded for over the past 20 or 30 years. So, please.
Look, I think that is the biggest unlock for enterprises. We have almost tried to take risk out of how you manage a process and how you manage an enterprise. It is the shortest way to go fail. Now, you don't want to take risk that destroys the enterprise, but how do you perhaps take 2 to 3% of your internal budgets and reward people, go try it out, fully expecting that over half will fail when they go try it, but the half who succeed, then you double down and scale it completely. And let the half who fail, kill it quickly, but let them try something else. So how do you start rewarding people for experimentation is going to be a massive unlock. You mentioned HR. Our HR leader stepped up about 3 years ago and said, let me see if AI can help us do it. Half the functions, no chance. Advising people on how the team should be structured, advising people on what are people's gaps. That portion of HR, AI is not being able to help today at all, I would say. The other half of HR is, I call it transactional. Promote somebody, change an address, provide a letter. All of that can be automated almost completely. So then you reward people. And by the way, her team of doing this is 6 people. It's not like it's a massive expense, but they try it out, they see if there's traction with the employees. If there is, they double down and go get it done and then move on. I think that is the experimentation that we have to do, but it does mean taking some risk, because some are going to kind of fall flat on their face.
Right. And so then, of course, executives, in some sense, are responsible to the capital markets, right, and what investors will think. So you posited a number, and let's just use these as back-of-envelope numbers rather than promises, but 2 to 3% of budgets, half of which will fail. Well, that's 1 to 1.5% that could be observed by a shareholder as being thrown away. So do you think that there's some way of shifting investor expectations of what good performance from a firm should look like in this environment, Joe?
Well, again, I think it's you got to think about the horizon. Again, I'm not a business leader that has that sort of responsibility, but in terms of thinking about the ROI, without doubt, the one example of technology, the one characteristic, without exception, since the Industrial Revolution, is that there is sunk cost, and the payoffs are not immediate. I think that's why also there's the risk of underestimating the S-curve, right? It's that wonderful thing of you're disappointed in the short run, but then actually surprised on the upside. It's a nonlinear process, and I think that's part of it. So answering your question, Azeem, I think it's just having and I think it takes courage. I mean, I don't envy someone being a CEO, but being able to say we are deploying capital, and it makes a lot of sense to me, right? But I can imagine that's a tough challenge when you don't know the ROI of something. But I think the experimentation, we just know that the great companies, one characteristic in them is having the fortitude to have a longer horizon, and then to deploy capital. So I'm just listening to Arvind with the counsel, because
I actually think investors are far more willing to let people take risks. So if you say, I am going to spend this, you quantify it, your point was 1 to 2% for a year or two, and then you're going to see higher returns on cash flow and returns, but it's going to be 2 years out or 3 years out, they will absolutely have that patience. Now, if you say it's 10 years out, that's a little bit different. But I'm not going to go spend that amount of money unless I see a return. So it's not as simple as you take half of 3% and it's wasted. But on the 1.5% that works, I'm getting 10 times the return. So that's actually right there, and that's the $1.6 billion I spoke about, or that's the 10% overall that you can get to from those, because those little pieces then accumulate up, and within 2 years, you're getting far more back than you're actually expending on the experimentation.
So if we think about the result, the consequences of that experimentation, what are the hallmarks of the firms that are well placed at the current state of AI's maturity to experiment? You know, there are some that it feels it's more natural. It's more natural for an IBM. You're a digital company. You help other companies with these problems. I'm not surprised to hear you experiment with this internally. But what should we be looking for in the companies who are better positioned to do this now?
Look, number one is it's not so much a technology lens I'll speak of. Number one is having the people with the right mindset and the right attitudes amongst those who own functions inside. Well, the average enterprise is comprised of anywhere from 100 to 800 functions. It's not like that small a number. If you take those functions and think about those leaders, how are you selecting people to run those? Are you looking at them just to run it as it was and go extract 1, 2, 3% productivity each year? Or are you looking at them to see can they fundamentally rethink and retransform those processes? That's a very different criteria for picking leaders than historically has been in place. Then you have to say, back to my risk point, can you let them take some risk, and how much autonomy do you give them for taking those risks? I think those are the biggest points. Then a piece that always has been talked about, you need to have a data regime and thinking about how the data is. In the end of the day, AI is a form of data. It's not something that is, it's math and data. So what are you thinking about your data? Who gets access? Where does it go? Where does it live? Once it's captured in a model and you put that model out, it's going to escape. So you got to think through those pieces. And that is why I think the reluctance from some is mostly around that third dimension than anything else, because they're not sure whether they're giving up some implicit value in that data. So I do think we have to think about ways and techniques to bring and keep the outcome of the data, which is the model, confined to the enterprise. It is their IP, not somebody else's. Those are sort of the three pieces. But note, I started with the people side and went to the tech later.
Now, we're going to come to questions from our attendees in a few minutes. So if you want to start to warm up your own grey matter, real intelligence up there. AI is not static as a technology, though, either. And we'll just, with a couple of data points, 2 or 3 years ago, these large language models could hold about 100 words in their working memory. It was a couple of hundred tokens, it was called. Today, that number is up to 1.5 million or 10 million, so it's entire videos or tracts of text. That's just in 2 years. The cost to access these models, GPT-4 is the benchmark model still today, has dropped by a factor of 250 in about 18 months. And so we have a technology that is far from static. It's quite dynamic and could be continuously improving. That could lead you to say, well, I'll just wait a little bit longer till it's a little bit cheaper and somewhat better and less hard to use before I make my decision. So there is a lot of confounding issues around something that is as dynamic as this. How do you think firms should approach this? Joe, we'll start with you and go to Arvind and then come to questions.
And I can provide perhaps the macro sort of backdrop. And I think, again, it's I look back only because it provides context, whether it's electricity, the personal computer, the transistor, those sort of electronic technologies. And again, it's easy to have hindsight bias. And you look at the personal computer. Oh, of course, I knew what the late 90s was, right? Because I'm sitting here today in the year it is. But I think it is, history shows that if once there's significant investment and there's limited cases, but there's strong evidence of productivity unlock, it eventually is used by other industries and businesses. And so I think it still is a little bit of a leap of faith, but I think it's a very calculated and safe risk. And so again, from a macro perspective, there's advantages of learning by doing. Every technology on this planet for the past 500 years, there's been a critical element of learning by doing, and it's that reinforcement loop that leads to unexpected developments and so forth. And so, in fact, we've actually looked at where great ideas come from. You can think of the iPhone. We looked at the Wright brothers plane. We looked at all patent records, and we're actually able to trace every idea in its evolution. 6 billion ideas over the past 25 years. This is the amount of data we've brought to bear. And the one common thread through all those rates of innovation is the unexpected discoveries that come in from another idea. And I think what's happened is that it's the learning by doing mode, and two smart people in two different fields say, I actually never thought of combining this with that. You know, peanut butter and jelly. I don't know what the combinations are, but it's that sort of thing. So I'm not Smith. I'm saying in a macro perspective, I don't run I have the responsibility of running a company, but I can tell you the empirical evidence is really strong, which I think gets to your point of calculated risk. The risk, I think, is actually not doing the experimentation because of the learning that employees themselves, which can lead to an insight down the line.
Look, it's that, I'll pick up on the learning by doing. That 2 to 3 years, suppose you decide to wait. You could wait 2 years. Now you've lost 2 years of your people getting to know the technology, people getting to know what are the risks and limitations, people figuring out, will this or will this not apply? That 2 years in modern business can kill a company. Because if your competitors are that far ahead and they're waiting for that price point, it comes, and then they embrace it because they're completely ready, and they pick up that 10% productivity, you have two companies. Average bottom line in the S&P is about 10%. So if somebody's sitting at 20, that means they have twice the investment power of those who are sitting at 10. They're going to run away with the market at that point because they can do everything possible, and you can see this again and again and again. So that 2 years, while it's correct that the price point will come down, I almost invert it. Let's get ready so that we can take even more advantage of it 2 years out, as opposed to wait for that price point to come down.
Thank you. Wonderful. We'll turn to attendees for questions. There are a couple of mics running around. If you pop your hand up, and the gentleman up there.
Humans getting closer to compute, right, our interface to compute. The death of SaaS, the death of software due to AI. Benioff has come out and said, oh, no, it'll be fine. But if all our data is just tables and text files, do we actually need software anymore? So when we talk about disruption, the very people that have built this disruption are actually at risk. You have any thoughts on that?
Arvind, I think this is definitely one in your wheelhouse. Death of software.
Look, I love Mark. Mark's wonderful. He's a foresighted businessman. He's a foresighted technologist. And it's complete and utter BS, I'll say, when we say it's going to be the death of SaaS and the death of software. Is the software engineer going to be far more productive leveraging AI? Absolutely. Which one of you who runs a company would not take their software team to be 30 or 50% more productive? Actually, you would not reduce a single software engineer. You would just get more done because there is so much to be done that you haven't gotten it done. That's what it'll do to that side of it. Two, how it gets delivered. If those of you who remember Salesforce, when he said Mark, I assume he meant Mark Benioff of Salesforce. Mark began by saying, there is no software, because it was a nice quote, but that was meant to be that you didn't have to go manage it and install it yourself. There was a lot of software. There is actually hundreds of millions of lines of software, but it is run by Salesforce engineers, not by the average client. I actually think that AI is going to unlock, and our estimates are anywhere from 6 to 600 million new applications that are going to be comprised of software. In the end, AI is just math embodied in computers as software, and it'll go out and do these things for people. Where will it run? I think it depends on the size of the enterprise. Very large enterprises may run it themselves. They are much more concerned about the data, the privacy, the IP, the brand reputation. Smaller ones don't have a choice. They will run it from the cloud on somebody else's application and share it, is where I think it'll go. But it'll unlock millions. Low or upper bound, like Joe here, I'm just giving a massive range.
Great, thank you. Another question, perhaps? Yes.
Hi, thank you. As it relates to markets, economies, currencies, et cetera, what are the hiccups? What could go wrong over the next few years, similar to 2003 and then going backwards to the 70s and so on? What are the risks? What could happen?
I'll give you two. because of the system we've engineered and spent a lot of time building, is that we have an explicit line of sight between the evolution of technology, not just on growth and inflation and interest rates, but on the equity market in the day-to-day, as well as what's consistent with the outcomes, because we can compare now apples and apples, not apples and there's an orange out there. And so when we do that, to answer your question, is even though we are projecting a 2-to-1 odds that AI is more transformational than the personal computer over the next 15 years, it's not foregone. 2-to-1 is effectively 2/3 to 1/3 because AI still has to develop. Now, I bring that up because now if you look at the equity market today in the United States and its exceptional performance, and you calculate the same odds based upon the same algorithm, you get the U.S. stock market assigning a 90% probability that that will happen. So even though I'm fairly constructive, Vanguard would be fairly constructive on AI's potential for economic growth, it is not as high as 90%. So one of two things have to happen. Either our model will catch up to where the equity market is, or where the strong empirical evidence is that there's a disappointment at time, even though the technology ultimately transforms the economy. And that's the irony between investing in technology and what it does to the economy. Electricity, because it's the competition that comes in, the return on capital, the amount of companies, that's huge for growth, but there's winners and losers. You mentioned it with creative destruction. So the overvaluation, the equity market, I'll pick a year. I won't say 1999, because that implies an imminent fall. I'll say 1997 versus the economies in 1992. And so there's that disconnect. Now, what I'm saying is there's downside risk in the equity risk premium or the equity stock market. It is not because investors are over their skis or this technology is not going to be transformative. It's just that the discount rate that it's applying to future growth, it's set up for some period of disappointment, and there will be winners and losers in that transition. So hopefully that's helpful.
Well, let's go a little bit further then. So how specifically should investors think about positioning their portfolios?
Well, what our research was, this was eye-opening to me, because the intuition I had going into our whole research project was, if this technology is transformative, invest in the companies that do the transformation. And that is certainly true in the first phase of, let's say, a decade to 2-decade long cycle. But what history shows and the empirical evidence supports is that when there's general purpose technology, again, it is broadening out. The very fact that the economy is being transformed means the hospitals are using it and utility companies are using electricity, not just General Electric. What that means is the profitability of the companies outside the technology sphere are actually, their profitability is going up as the economy is being transferred. So the long play is actually overweighting value-based companies in a period of growth, whereas it's overweighting growth companies in a period where growth is at a premium because growth is low. So it's an ironic twist in terms of what we do. I'm not saying that investing. Now here's the catch. If you can identify companies better than the average investor, I'm at best average. So 4% of the companies explain half of the S&P 500's climb over the past 100 years. 4% of the companies. Mm-hmm. So if you're that skilled to pick that, because the future leader in the technology space, they emerge from that creative destruction. It's just that there's high failure rates because of the churning of the process. So hopefully that's helpful. So if you want to index it and you want to deviate from the market, you would be going outside of technology. But if you have the foresight and the skill, the ability to say, no, what I think I know how technology is going to evolve, it's the IBMs of the world or so forth, then that's how you would want to deploy capital.
Great, thank you. Another question, the lady over there. Yeah.
Thanks. This is a really great discussion this morning. We spoke earlier about how the U.S.'s adoption of the internet. What do you think I'm interested to hear your perspective, Arvind, what's your perspective on having the rest of the world come along, whether it's Asian companies, European companies? I was just in Europe, and the pitch is not as loud there, and I'm just curious about what will it take to bring everybody else along.
Look, so Europe is different from Asia. I actually think Asia is going to come along because if I look at Japan, India, Australia, et cetera, they make noises around data protection, but they are trying very hard to not restrict their companies from participating in the AI economy and digital economy. Europe has managed to get itself into a little bit of a funk. They are so heavily regulated, and then you can even pass a regulation that I would actually agree with. I think the EU AI Act is a reasonable piece of legislation. But then legislation is not legislation. You get down into rulemaking. And they seem to have an incredible ability to take a reasonable regulation and make it into an insane set of rules that pretty much stomps on innovation. Okay, if that becomes how they're going to interpret the current set of AI, and I agree, there are potential risks. But if you don't allow innovation to happen up front, you're not going to let the companies there thrive. So there are a couple, but there aren't that many that are thriving. Now, the flip side of where they'll suffer, just like the internet, AI in the end is a digital technology. How do you stop a citizen or a company in Germany from accessing it, whether from the United States or the UK or China? You just cannot, unless you shut your borders to a digital framework. So what will happen is, I think this is going to play out much like the internet played out or smartphones played out, that you're going to see a nexus in those countries that allow innovation, and you're going to see that then all the rest of the world is effectively a consumer of that set of technologies. But don't forget the point that Joe keeps making. Electricity, utility companies are not the most highly valued today, but companies that use electricity are. So maybe in Europe, if you say 90% of the economy is not the companies who invent AI, but are those who consume it, will get the benefit. How about if we look at it more positively like that?
I'll add something to that. I'm based in Europe, and Arvind, very optimistic perspective. I think there's a couple of deep challenges in Europe. One relates to attitudes towards technology in general. So Edelman runs its trust barometer every year. The 2024 trust barometer, 10 months old, had 70+% of Europeans, including the UK, with a negative outlook on the potential of technology, and that was inverted in Asia, where people were generally much, much more optimistic. And Europe should do very well from this technology because it has such a demographic challenge. However, as you're starting to see in Germany, the unions are very, very strong, and European companies are generally a bit slower to buy technology. So I think it is a situation that could turn around, but my general reading is that it's a pretty tough place to be. But you, Joe, yesterday when we were discussing, had a different view on about what that means for European stocks relative to American stocks.
Well, and again, the history would tell you, you have to have, first of all, you have to have the stomach to look out beyond just the next 2 or 3 years, which is not easy. But there's always I'd say a horse race between momentum in the markets and then valuation. But of course, with valuation, it's assumed of just a reversion to the mean. So those investments that have underperformed for a long period of time, the loose framework is to say, okay, well, they will catch up. We have frameworks that we try to control for some of those things, because I would say the mean reversion is probably the most powerful force in finance. It's also the most dangerous. Because just because something went down does not mean it's going to come up. This is not like the tides in the ocean coming in and out. There could be a reason why interest rates aren't coming back up for a long, extended period of time. So when you control for some of those factors, the odds still tilt to valuation being a tailwind, effectively outside of everything U.S. and technology-based. But I would have said this on this stage 2 years ago, where the markets has been exceptional. So you have to have the courage, and I think you would want to control for some of those things. So there are some nations, countries, you see it, that they seem investable, and then for every United States, there's the Argentina in 1850. Now it's still emerging in market, right? So there's noise around the sample, but that's where I would say your default should be.
Sure.
Then what other information and sort of frameworks do you have? Your strong priors. You say, no, you know what, though, I'm very skeptical of Europe because of the regulation I'm seeing. And so then you would say, okay, and that's what great active managers do. They oversample, but the default should be, I have historical empirics on my side, and then you deviate based upon your own qualitative and quantitative judgment. So that's how I would try to think about it.
Wonderful. I'm going to ask one last short question, then have to sum up because we're out of time. So we're 2 years on into this generative AI wave that has created a lot of business for your company, Arvind. And I think most of us were surprised to the upside. If you'd gone back and asked us back in November 2022 what kind of conversation we'll be having about this. So looking out over the next 2 years, do you think you are more likely to be surprised to the upside or the downside when you think about the impact of AI? I mean, we'll start with Arvind, come to Joe. Brief answers so I can sum up.
In terms of deployment in the enterprise, because that's what we are. We're not a consumer company, we're an enterprise company. We're going to be surprised to the upside. I actually think 90%, I think I'll be more precise, 88% of what has been out there so far is in the B2C world. The enterprise world catches up, it's a bit slower, and it is going to surprise us massively to the upside.
I'd say on the automation side, we'll be surprised at the upside. The transformation, I think, will take more time, which is the knock-on effects.
Great. Thank you. Well, this has been a fantastic discussion. I'll try to summarize a couple of key points here that have emerged. Joe's made a strong case for AI as a general purpose technology, as a technology that can be a significant boost to productivity, identifying the challenges to how it will reshape the labor market, but cautioning us against any hugely dystopian futures. Arvind has described already IBM's incredible internal successes in improving its own operations through the use of one type of AI, but also the ongoing demand from enterprises, so real businesses buying real technologies for real reasons. And I think that's a great summary of where we've got to and where we will come back to. And hopefully in a couple of years' time, we'll be able to sit down again and say, just how surprised were we with how the next 2 years panned out. Thank you very much.
Thank you.
Thank you.